Silver does not usually announce itself quietly, but this time the message arrived with unusual clarity. As trading data filtered out of Asia, one number cut through the noise: $91. Not on a rumor board, not on a speculative futures screen, but printed in Shanghai. A market built around physical delivery rather than paper promises. For global traders preparing for Monday's open, the implication was immediate and uncomfortable. If silver is clearing at $91 where metal changes hands, then the rest of the world must explain why it is not. To understand why this matters, it is important to recognize what Shanghai represents. Unlike Western futures exchanges that revolve around leveraged contracts, Shanghai's precious metals markets are rooted in physical settlement. Bars move, inventory matters. Delivery deadlines are enforced. When prices rise there, they reflect scarcity, demand, and the real cost of sourcing metal. A $91 print is not merely a price. It is a signal that physical silver is being bid aggressively at levels far beyond what paper markets have been pricing. For decades, COMEX has functioned as the global reference point for silver pricing. Futures traded there set benchmarks used by refiners, miners, manufacturers, and investors worldwide. But COMEX is fundamentally a paper market. The vast majority of contracts never result in delivery. And open interest routinely dwarfs registered inventory. That structure works as long as confidence holds, as long as participants believe metal can be delivered if demanded. Shanghai's $91 signal challenges that belief. The gap between paper and physical markets has existed before, but rarely at this scale. When the difference becomes large, it forces uncomfortable questions. Are futures prices suppressed by leverage and short positioning? Are inventories overstated? Is demand being underestimated? Or has the world simply accepted a pricing mechanism that no longer reflects reality? Shanghai does not answer these questions directly, but it forces them into the open. The timing of this move adds to its impact. It arrives at a moment when global supply chains are already strained, when energy costs remain elevated, and when industrial demand for silver continues to rise. Solar manufacturing, electrification, medical technology, and advanced electronics all depend on silver's unmatched conductivity. These are not speculative uses, they are structural. When industrial buyers compete with investors for limited supply, prices do not rise gently. At $91, silver is no longer behaving like a secondary precious metal. It becomes a macro asset, capable of transmitting stress across markets. Margin systems recalibrate, hedging strategies unravel. Correlations that once seemed stable begin to break. Traders who treated silver as a sideshow are forced to reassess its role because the metal is now sending signals typically associated with currency instability and inflationary pressure. COMEX enters this moment under scrutiny. The exchange's silver contracts are backed by warehouses that report inventory levels, categorized as eligible and registered. Eligible metal meets exchange standards but is not committed to delivery. Registered metal is available to satisfy contracts. Over time, registered inventories have declined relative to open interest, increasing leverage within the system. This is not inherently a crisis until delivery demand rises. Shanghai's print raises the possibility that delivery demand could rise sharply. If arbitrageurs attempt to buy silver on COMEX and sell into Shanghai, they must take delivery. That process drains registered inventory. If inventories fall too low, the exchange faces pressure to discourage delivery through higher margins, cash settlement incentives, or rule adjustments. Each of these responses may stabilize the system, but each also signals stress. The paper-silver market has always relied on a simple assumption. Most participants prefer cash settlement. They trade exposure, not metal. That assumption allows leverage to expand far beyond physical supply. But assumptions are fragile. When price signals suggest scarcity, behavior changes. Participants who never intended to take delivery reconsider, not because they want bars, but because delivery becomes leverage in itself. This dynamic places bullion banks in a difficult position. As market makers, they provide liquidity, take the other side of trades, and hedge exposure across venues. Many maintain short positions as part of that role, confident they can roll contracts forward or source metal if needed. A sustained divergence between Shanghai and COMEX undermines that confidence. Losses grow with each dollar increase, and hedges tied to correlated markets may fail to offset risk. Short positions are particularly vulnerable in environments like this. Unlike long positions, where losses are capped at the investment, shorts face theoretically unlimited risk. When prices rise rapidly, margin calls follow. If collateral cannot be posted, positions are liquidated automatically. This forced buying pushes prices higher still, creating feedback loops that can overwhelm liquidity. $91 is a level at which these dynamics intensify. Retail investors often capture headlines during commodity surges, but they are rarely the decisive force. The real pressure comes from institutional positioning and industrial demand. Manufacturers cannot simply exit the market when prices rise. They must secure supply. If procurement managers conclude that weighting risks shortages, they lock in contracts at elevated prices. This behavior anchors higher price levels and reduces the effectiveness of speculative selling. Currency dynamics add another layer. Silver is priced globally in US dollars, but it trades against local currencies in physical markets. A rising silver price can reflect dollar weakness, but it can also reflect regional demand imbalances. Shanghai's $91 print suggests that, in yuan terms, buyers are willing to pay significantly more than Western benchmarks imply. That divergence can persist only briefly before arbitrage forces convergence, unless barriers intervene. Those barriers may be logistical, regulatory, or political. Export restrictions, capital controls, shipping constraints, and differing standards can all slow arbitrage. In the short term, these frictions allow price gaps to widen. In the longer term, they expose weaknesses in the global pricing architecture. If the world relies on a paper benchmark that cannot clear physical demand efficiently, that benchmark loses authority. History offers warnings. In past episodes, where physical markets overpowered paper pricing, exchanges responded with rule changes designed to preserve stability. Margin hikes, position limits, and altered settlement terms have all been used. These tools can diffuse immediate crises, but they often carry reputational costs. Market participants remember when rules change mid-game, and that memory shapes future behavior. The industrial implications of sustained high silver prices are profound. Solar panel manufacturers operate on thin margins and massive volumes. Even small increases in input costs ripple through project economics. Electric vehicle producers face similar pressures. While substitution and efficiency gains are possible, they require time and investment. In the interim, higher silver prices translate into higher costs, reinforcing inflationary trends that policymakers are eager to contain. Mining supply cannot respond quickly. Bringing new silver production online takes years of exploration, permitting, financing, and construction. Many silver mines are byproducts of lead, zinc, or copper operations, meaning output is tied to broader base metal economics rather than silver prices alone. Even at $91, supply elasticity remains limited in the near term. Investor psychology shifts rapidly at moments like this. Assets once dismissed as dull become urgent. Narratives change from skepticism to justification. Analysts who ignored silver begin publishing explanations, while those who warned of structural shortages gain attention. This shift does not guarantee sustained price increases, but it alters the baseline from which future moves are judged. As Monday approaches, COMEX faces a test of confidence. If futures prices gap higher toward Shanghai levels, volatility will surge, but alignment will improve. If the gap persists, pressure will mount. Traders will probe for weaknesses, testing delivery mechanisms and settlement processes. Each response by the exchange will be scrutinized not just for effectiveness, but for what it reveals about underlying conditions. The broader market watches closely because silver rarely moves alone. Stress in precious metals often precedes adjustments in currencies, bonds, and equities. When a metal that serves both industrial and monetary roles sends extreme signals, it suggests that multiple systems are under strain simultaneously. Ignoring that message has historically proven costly. This is not yet a verdict on COMEX, but it is a reckoning moment. $91 in Shanghai forces a comparison between promise and reality, between paper and metal. The outcome will depend on how markets respond when liquidity returns and trading resumes in full. In the next segment, we will examine how exchanges, regulators, and institutions may react, and why their choices could determine whether this divergence narrows quietly or escalates into a broader market confrontation. When markets reopen, the first response will not come from traders, but from systems. Risk engines will recalibrate, margin requirements will be reviewed, and clearing members will assess exposure across silver-linked products. At a Shanghai price of $91, silver is no longer operating within historical norms, and that forces institutional actors to act defensively. Liquidity, which appears abundant in calm conditions, often vanishes precisely when it is needed most. COMEX has several tools at its disposal, and history suggests it will not hesitate to use them. The most immediate lever is margin. By increasing the amount of capital required to hold silver futures positions, the exchange can rapidly reduce leverage. However, margin hikes do not distinguish between speculative excess and legitimate hedging. Industrial users, producers, and market makers are all affected equally. In stressed conditions, higher margins often trigger liquidation cascades rather than stability. Another potential response is a tightening of delivery rules. Exchanges can adjust incentives in subtle ways, making cash settlement more attractive than physical delivery. While such measures are typically justified as risk management, they carry symbolic weight. If market participants perceive that delivery is being discouraged at the moment it becomes valuable, confidence erodes. The price may stabilize temporarily, but trust in the mechanism weakens. Exchange-traded funds linked to silver become a focal point in this environment. These products promise exposure to silver prices, yet their ability to function smoothly depends on authorized participants sourcing metal efficiently. At $91, sourcing metal is no longer routine. Premiums rise, delivery times extend, and inventories tighten. Any sign that ETFs are relying more heavily on cash settlement or derivative exposure can accelerate investor concern. Arbitrage is often cited as the force that keeps markets aligned, but arbitrage requires access, capital, and time. Buying silver on COMEX and selling it into Shanghai is not as simple as clicking two buttons. It requires taking delivery, transporting metal, navigating customs, and managing currency conversion. Each step introduces friction. When prices move faster than logistics, arbitrage lags, allowing divergences to persist longer than theory predicts. Bullion banks, positioned between these markets, face intensifying pressure. Their role as intermediaries depends on their ability to hedge exposures across venues. When price gaps widen and volatility spikes, hedges become imperfect. Losses in one market may not be offset cleanly in another. Risk managers respond by reducing exposure, widening spreads, or withdrawing liquidity altogether. When liquidity providers step back, volatility feeds on itself. The impact does not stop with silver. Precious metals are deeply embedded in broader financial portfolios. Hedge funds often trade silver alongside gold, currencies, and interest rate products as part of macro strategies. Stress in one leg forces adjustments elsewhere. Positions are unwound, correlations shift, and assets once considered independent begin to move together. This is how a silver shock becomes a multi-asset event. Equity markets are particularly sensitive to signals coming from commodities. A sharp rise in silver prices can be interpreted as an inflation warning, a currency warning, or a supply chain warning. Growth stocks, which rely on stable discount rates and predictable costs, tend to react poorly to such signals. Even companies with no direct exposure to silver can feel the impact as investor risk appetite shifts. Bond markets, too, respond to commodity signals. Higher silver prices challenge narratives of declining inflation and stable monetary policy. If investors begin to question whether central banks have successfully contained price pressures, yields rise. Rising yields tighten financial conditions, affecting everything from mortgage rates to corporate borrowing costs. In this way, a metal market move feeds directly into the real economy. Regulators and policymakers monitor these dynamics closely, often without public comment. Their objective is not to control prices, but to prevent disorderly markets. Quiet conversations between exchanges, clearinghouses, and large institutions are common during periods of stress. The absence of headlines does not imply inaction. It often indicates that efforts are underway behind the scenes to manage risk without provoking panic. Industrial buyers face difficult decisions in parallel. For manufacturers dependent on silver, price spikes introduce procurement risk. Waiting for prices to fall may conserve capital, but it risks supply disruptions. Locking in contracts at elevated prices protects production, but compresses margins. These choices are made across industries simultaneously, reinforcing demand even as prices rise. One of the most underappreciated aspects of silver's surge is its impact on expectations. Markets are forward-looking. When participants observe silver clearing at $91 in a physical market, they revise assumptions about what is possible elsewhere. Analysts adjust models, traders adjust strategies, and investors adjust narratives. Even if prices retrace, the memory of the move lingers. As Monday's session unfolds, attention will focus on spreads between Shanghai and Western benchmarks. Narrowing spreads suggest successful adjustment, widening spreads signal escalating tension. Volume patterns, delivery notices, and warehouse reports will be scrutinized for clues. Small details take on outsized importance when confidence is at stake. This phase of the story is not about resolution, but about reaction. How COMEX and related institutions respond to the Shanghai signal will shape market behavior going forward. Transparency builds confidence, opacity invites speculation. Stability achieved through clear mechanisms endures longer than stability imposed through sudden rule changes. What is clear is that silver at $91 has shifted the conversation. It has moved silver from the margins of financial discourse to its center. The metal is no longer just an input or a hedge. It is a messenger, carrying information about stress, scarcity, and trust. In the final segment, we will explore the longer-term implications of this moment, what it could mean for global price discovery, for the balance between paper and physical markets, and for the future role of silver in the financial system. History suggests that moments like this rarely announce their long-term significance immediately. They begin as price anomalies, evolve into market stress, and only later are understood as turning points. Silver's $91 print in Shanghai fits that pattern. It is not simply a spike to be debated on trading desks. It is a challenge to the structure that has governed global silver pricing for decades. Whether that structure adapts or fractures will determine what comes next. There are precedents for paper markets losing authority when physical demand asserts itself. In multiple commodity cycles, from energy to base metals, prolonged divergence between futures prices and spot reality eventually forced recalibration. Sometimes that recalibration came through higher prices. Other times, it arrived through rule changes, consolidation, or the migration of price discovery to new venues. The common thread was credibility. Markets followed the venue that could reliably clear supply and demand. COMEX now faces that credibility test. If it can accommodate higher prices, facilitate delivery, and maintain orderly trading, it may preserve its role as a benchmark. That outcome would involve volatility, losses for some participants, and uncomfortable adjustments, but it would reaffirm the system's resilience. In this scenario, silver's surge becomes a painful but manageable episode, a reminder rather than a rupture. The alternative is less orderly. If delivery becomes constrained, if settlement rules are altered abruptly, or if participants perceive that paper claims are being protected at the expense of physical holders, trust erodes. Markets do not require perfection, but they do require consistency. Once traders believe that rules change when pressure rises, they begin to discount the value of participation. Liquidity migrates quietly at first, then all at once. Shanghai's role in this process is critical. As an exchange centered on physical settlement and backed by a growing share of global industrial demand, it offers an alternative reference point. If prices there continue to diverge meaningfully from Western benchmarks, participants will increasingly treat Shanghai prices as reality and others as approximation. That shift would not happen overnight, but it would represent a profound change in how silver is valued worldwide. Central banks and governments cannot ignore such a shift. Precious metals have always occupied a sensitive position in monetary systems, even when officially sidelined. A sustained rise in silver prices, particularly one driven by physical demand, challenges narratives of stability and control. Policymakers may respond with reassurance, regulation, or strategic stockpile management, but their influence is indirect. Markets ultimately decide which signals to trust. For industrial users, the long-term response will be adaptation. Higher and more volatile silver prices encourage efficiency, recycling, and substitution where possible. Over time, technology adjusts, but those adjustments lag price signals sometimes by years. In the interim, elevated prices act as a tax on production, feeding into broader inflation dynamics that extend beyond the metals market. Investors will interpret this episode through different lenses. Some will see confirmation that hard assets remain essential hedges in an era of debt and currency expansion. Others will view the volatility as a warning against complacency and leverage. The divide between strategic allocation and speculative exposure will become clearer as the market digests the move. Those distinctions matter because they shape whether demand persists or fades. Mining supply will respond eventually, but not immediately. Capital will flow toward exploration and development if prices remain supportive, yet permitting environmental scrutiny and geopolitical uncertainty limit how fast new projects can advance. Silver's supply profile, heavily dependent on byproduct production, further constrains responsiveness. These realities suggest that any repricing driven by genuine scarcity is unlikely to reverse quickly. What happens after Monday will not be decided in a single session. Markets will probe, test, and reassess over weeks and months. Warehouse reports, delivery notices, and cross-market spreads will become signals watched as closely as prices themselves. Each data point will either reinforce confidence or raise new doubts. In this environment, transparency becomes as valuable as liquidity. There's also a broader philosophical implication. Modern financial markets rely heavily on abstraction, contracts, derivatives, and models that simplify complexity. Physical markets reintroduce friction and constraint. When those two worlds diverge sharply, the abstraction is forced to reconcile with reality. Silver's move brings that tension into focus. If this moment marks the beginning of a sustained shift, the implications extend beyond silver. Other commodities with similar paper-heavy structures may come under scrutiny. Price discovery could fragment, with regional markets asserting greater influence. Such changes unfold gradually, but they reshape the financial landscape in lasting ways. For now, the significance of silver at $91 lies in what it reveals, rather than what it resolves. It reveals pressure where comfort once existed, scarcity where abundance was assumed, and vulnerability where confidence prevailed. Markets can absorb shocks, but they cannot ignore messages indefinitely. As trading resumes and reactions play out, headlines will focus on volatility, winners, and losers. Yet beneath those narratives runs a deeper story about trust, structure, and the limits of leverage. Silver, long treated as a secondary asset, has forced itself into the center of that story. Whether COMEX emerges strengthened or diminished will depend on choices made under pressure. Accommodation or resistance, transparency or opacity, adaptation or denial, each path carries consequences. The reckoning implied by Shanghai's $91 print is not predetermined, but it is unavoidable. In the end, markets tend to remember moments when reality asserted itself. This may be one of them. Silver is spoken not through commentary or theory, but through price. What the global financial system does with that message will define the next chapter.